It was another impressive day for the U.S. stock market, with the S&P 500 closing higher by over 0.5%. This is actually the third straight day to the upside, which hasn't happened in over a month. And from the lows on Friday morning, we're up over 3%, which is a pretty healthy amount in a very short amount of time. So a lot of this has been spurred along by finally a bit of falling interest rates. We'll talk about that in tonight's video. Of course, we saw hints of that yesterday, but with the bond market officially closed yesterday, it was nice to see that the expectations did come through. And so a lot of those interest rate sensitive areas like utilities and REITs and staples bounced back pretty nicely here today after getting roughed up tremendously in the month of September. So after having that discussion about the sector selector and sector rotation in tonight's video, we'll of course talk about other macro themes, some of the things that have been taking place since of course the terrible news over the weekend in the Middle East, and then we'll get into our trade application example. And after having a pretty solid week to the upside, I wanted to hunt down at least one bearish trade just in case this is a bit of a head fake from the market. And so in tonight's video, I'll show you how to do a short sale on a big tech stock within the United States. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 10th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also be given a heads up at what stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. Just as a quick aside, be aware that I will not be doing the video this Thursday, so mentioned that last week as well, but just wanted to reiterate it so that way you're not surprised if you don't get an email from me on this Thursday, as I have some out-of-town guests staying with me, and we'll be out and about doing things, and so taking a day off there in that regard. But we'll be back to my normal schedule a week from today, and so look forward to that as well. But just a quick heads up so that way you're not caught by surprise if you're not seeing a video from me on this Thursday. In addition to that, we are heavy users of X, formerly known as Twitter. And you can follow me at Brandon Van Zee if you haven't done so already. We really appreciate those of you that click like and repost on those tweet/posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And it was a green one. As you can see, we've got our S&P 500 heat map pulled up here in front of us. And it was another pretty good day. Remember that yesterday was a holiday here in the United States, not one in which the stock market was closed, but one in which the bond market was closed. So we weren't quite sure exactly what would happen with interest rates. We had a good hunch, given, of course, the terrible news that happened in the Middle East, particularly Israel here over the weekend. Of course, thoughts and prayers are going out to those affected by that terrible tragedy over there, but had a fairly decent idea as to which direction rates would be going once markets reopen this week. And so far, they have confirmed what the hunch would be, which is interest rates going lower. And as we've talked about a number of times recently, one of the major headwinds of the market has been rising interest rates. And so any relief, even if it was as a result of a terrible tragedy like this, whatever was going to cause the relief in ever rising interest rates could spur on a little bit of a stock market rally. And that's kind of what we've been in the midst of here. We've actually had 3 days in a row to the upside on the S&P 500, and that hasn't happened in over a month, right? It's not that 3 days in a row is particularly earth-shattering or anything like that, but it has been a difficult go of things here in the stock market recently, as it oftentimes is in September and October time periods. So anyway, we'll take what we can get from that regard. And it's actually been a pretty good run of things here. One thing that kind of stood out to me today when I look at the heat map here is that today felt like a day where more of your traditional dividend stocks outperformed, let's say, your tech stocks or your innovative, disruptive, compounding types of companies that are out there. And that's different than what we have been used to for much of 2023. It has been difficult, to say the least, for those dividend payers. In fact, some of you might have seen my tweet here earlier this morning in regards to the statistics about how bad it is specifically within the defensive areas of healthcare, staples, and utilities. By some metrics, we are in our worst sell-off in those areas since going all the way back to 2008 and 2009. So we're talking about 15-year type of a sell-off that we're in the midst of with those defensive areas at the moment. Utilities do remain the worst performing sector in the entire S&P 500 this year. So today, with interest rates pulling back yet again, we had kind of an opportunity for those beaten down areas to bounce back, and it seems like that is what we received. One stock that certainly catches my eye is Pepsi, which then spurred on Coca-Cola. Some of you that have been following my tweets here over the past week will know that Coca-Cola, I believe it was on Thursday, dropped into the blue zone of the dividend stair-step chart for the first time since 2020. So over 3 years, somebody would have had to wait to buy that at an appropriate price for a long-term investor. And then the very next morning, on Friday morning, Pepsi also dropped into the blue zone on the dividend stair-step chart that we have here at Market Scholars for the very first time since 2020. So in both of those cases, for both of those high-quality dividend kings, meaning that they've raised their dividends for more than 50 years in a row, that was the first time you've had an opportunity to buy them at acceptable levels in over 3 years. That's really saying something, right? We also saw that last week, by the way, with Johnson & Johnson. It's just that Johnson & Johnson has given us maybe one or two other opportunities along the way. For Coca-Cola and Pepsi, they've been kind of sky high in the stratosphere away from kind of rational valuations here since 2020. So for those of you that have access to the dividend stair-step charts or were simply following me on Twitter, I think sometimes folks think that anybody who is involved in the financial markets on Twitter is focused on short-term day trading or something like that. But I hope to prove the point that even for those of you that are long-term dividend investors, I hope to provide value for you there on X/Twitter. So both of those touched the blue zone late last week. Both of them have bounced out of the blue zone as of this moment. And of course, Pepsi was one of the biggest companies to report their earnings today, and that's kind of what helped spur on that rally even further than just, the interest rate sensitivity aspect of it. So both Coca-Cola and Pepsi up about 2% here today. In addition to that, Target had a big day. They were up almost 4%. At one point earlier in the session they were, but they finished a bit off of their highs. So strong day there for a lot of those retailers. Dollar Tree, Dollar General also closed higher by over 3%. Those areas have really been bombed out here lately for a variety of reasons, including, the whole aspect of shrink and transportation costs and inflation and, student loan repayments. There seems like there's been, a smorgasbord of negative headwinds that you could kind of associate with the downward trending stock prices of those retailers, but certainly got a nice little rally out of them today. Boeing caught a little bit of a bid here today. Remember that they are kind of a quasi military/commercial business. I think a lot of us associate Boeing with the commercial side, but they do have a military side as well. I don't think they were up as much as some of those others like Lockheed Martin yesterday, which would have been the first trading day after the Israel news broke out. And so I don't know if today was a little bit of a rebound because they're playing a little bit of catch up there, or if there was another individual story affecting them. But they certainly stood out within the aerospace and defense area that was by far and away the best performing industry yesterday. Some of those names were up like 10%. I know L3 Harris was up 10% yesterday, and General Dynamics was up nearly 10%. So some huge moves yesterday, and some of them gave back a bit today, but it wasn't all that aggressive. They didn't give back everything. Net, there's still a very strong performance in those groups right there. We saw some of the travel names bouncing back. Good to see Airbnb up 2%, or actually 3% here today. Some of those hotel names like Marriott and Hilton, both up over 2%. So some big movers there. We saw the utilities finally have a very good day. Of course, the stock that everybody's been talking about lately, especially those of us in our dividend growth investing circles, is NextEra Energy, as there has been an epic rug pull underneath ticker symbol NEE for the last couple of weeks. But today, getting a little bit of a bounce. Who knows if that's a dead cat bounce, but at least it stopped going down for the time being and was up 4.5% here today. That is a dividend aristocrat that has rarely been on sale over the years, but at this moment in time, it has finally gotten there, and it got there in a hurry, as we've mentioned in recent weeks during this presentation. So the utilities had a good day, which makes sense. Again, we'll talk about interest rates here in a little bit, but just take my word for it now that interest rates did fall, and actually a fair bit here today, and so that really egged on that utility area right there. You saw some of the financials do okay. It was maybe a little bit more hit and miss because you had a handful of them, like your insurance companies that were down a bit today. Now, interestingly enough, I just referenced those insurance companies yesterday in my top-down trend trading class, mentioning that they, of all the areas within the financial services sector, were actually holding up the best. So it's kind of interesting today. There was kind of one of those role reversal days where the banks that had been doing poorly were actually bouncing back nicely today. Bank of America up about 2.5% there. And those that had been doing well, the insurance companies, were actually giving some back. So a little bit of a rearranging of the deck chairs there, perhaps. So, today was a day that seems to be classified as, a bounce back for a lot of those areas that had been underperforming. We'll see if that can be a transition for this market or if this was just one of those noise types of days and we're right back into those ugly trends sooner rather than later. But for one day, a little bit of bounce back out of those interest rate sensitive areas led by utilities and consumer staples, a handful of healthcare names, etc. In terms of the Magnificent Seven, it was a bit of a split day. You can see that Apple and Microsoft, as the two largest companies within the Magnificent Seven, were both down today. Not significantly, but it is at least noteworthy. I mean, today was a day where the market itself was up over 0.5%, and so to have that happen on a day when the two most important companies within the market were down about 0.5%, that's showing a little bit of underperformance there. And again, another way to see that today was one of those days that kind of, flowed back and money flowed back towards some of those, higher dividend yielding areas. Of course, Apple and Microsoft both pay a dividend, but they're next to nothing these days, mostly because their share prices have exploded higher over time. And as most of you know, when share prices go higher, all else being equal, dividend yields go lower. So it's not really their fault. They've grown their dividends nicely over the years. It's just that their stock price has erupted by an even more substantial amount. But today was one of those give back days. Oracle was down about 0.5%. We'll actually be talking about that stock a little bit later on in tonight's video. Google within the Magnificent Seven was also down alongside Microsoft and Apple. Of course, Google within the communication services area. And while Netflix isn't technically part of the Magnificent Seven, of course, it's part of the old FANG acronym. And today was a pretty terrible day for Netflix, one of the worst performers within the market, down about 3.3% here today. So a little bit of an oddball action there out of that one. In terms of the other Magnificent Seven companies, NVIDIA was up over 1%, so strong day there for the semiconductors. Meta was up over 1%, so pretty good performance there. Tesla was the best performer within the Magnificent Seven, up 1.5%. And then Amazon had a reasonably good day, up about 1%. Of course, today is another one of those Prime Day deals for Amazon. So for those of you that want to do a little early Christmas shopping, perhaps you can save a few bucks here today and tomorrow on Amazon. And it looks like the stock market was cheering that stock on to a degree here today. In terms of other areas that were out of favor today, like I mentioned before, healthcare was a bit hit and miss. You had a lot of areas of the smaller healthcare companies that were certainly in the green, but you had some of the bigger kind of pharmaceutical-related names that ended up in the red today. The worst amongst them appears to be Merck, down about 1% here today. And then you can also see that oil stocks were out of favor. Of course, yesterday was a big jolt higher in oil after the Israel news, but today maybe giving a little bit of those gains back here. A stock like ConocoPhillips down down over 1% here today. So all in all, I would say this was a productive day. Now, of course, you've got to judge that through my lens, and as a dividend investor, I, of course, would be a little bit happier on a day like today than not. Those of you that have heavy allocations towards Apple, Microsoft, and Google, perhaps you're thinking a little bit differently than I am. But all in all, I would say it was nice to have kind of the love gets spread across the stock market a bit more than the kind of concentrated levels that we had been dealing with here earlier this year. Another thing I wanted to show you here, this is the FinViz version of the heat map, so it allows us a little bit more functionality than the one over on Thinkorswim. This is the one-day performance of the S&P 500, but if I hit the drop down here and go to 1 week performance, take a look at how this will change the look, and it's going to brighten dramatically from a green perspective. You've got still some of your consumer staples and maybe some of your energy stocks and a couple of your healthcare companies out of favor, but the rest of the market really brightened up, including Apple and Microsoft and Nvidia. You know, those Magnificent Seven companies, they're all up in the last week, not only up a little bit, but up tremendously, right? With Tesla and Meta up basically 7% to lead the way. And the worst performer amongst them is Apple, which was still up 3.5%, which is huge when we're talking about nearly $3 trillion market cap there. So really good performance in the stock market over the past 1 week, and that may be surprising to some. I think there's still a lot of people that feel like we're really stuck in a rut at this moment, but it's interesting to see what 3 days in a row to the upside can do to market performance. Now, before we get too excited about that, I will now show you what the 1 month performance will look like instead of the 1 week, and here things will sour dramatically. So we are in a quite volatile market, back and forth they go. In a 1 week basis, we're looking really strong. On a 1 month basis, we are looking very weak, with the worst of the Magnificent Seven staring us in the face right there in the middle. Amazon down almost double-digit percentages despite today's 1% move higher. So you can see that the last month has not been kind to most stocks on the board. All right, let's go ahead and now take a look at the specific breadth numbers from today's trading over here on the Thinkorswim platform. And I've got the S&P 500 pulled up, and you can see that the advancers were 383, decliners 115. So today, that's good for about 76% of market components closing in the green today. It's a pretty strong breadth day. It's not overwhelming. You usually like to see them 80% or more if you can get it, but we're knocking on the door of that, so we weren't too far away from it here today, as a very good day for the typical stock in the market, even if the two largest market caps kind of sat today out. All right, let's now go ahead and jump into some charting action. And we've got our 4 grid pulled up here. This is chart 4B for those of you who are premium market scholars, following along with your own charting package at home. And remember, if you're not a premium market scholar, we will likely be throwing our traditional Black Friday sale here within the next month or so. And generally speaking, it's usually a 20% discount there. So if you've been kind of waiting for the right moment to join our premium education, where we do teach 10 weekly classes exclusively for our premium members, each with their own paper money portfolios that we are managing, both buying and selling, with a variety of strategies out there, in addition to, of course, all the tools that we give access to, like these charts. Then make sure you put that in the back of your mind as you're heading towards the holidays, perhaps a nice little gift for yourself if you're in the mode for investing education. Anyway, as you can see with our 4 grid here, we actually did have some interesting changes to reference here today. We do have a color change on the background from S&P 500 from dark pink to light green. Same thing is happening over here on the Dow Jones Industrial Average, dark pink to light green. What that references is today was a transition day from a posture perspective, using that intermediate line on the market forecast technical indicator, which is that green line you see down below in that indicator. So the reason that we went to this light green background here is because this dark green line down below, representing the intermediate time period, did emerge out of that lower reversal zone. And the same thing happened over here on the Dow. But just a friendly reminder, just because it's light green doesn't mean that it's strongly bullish. We would need it to have the dark green background color like right here and back here in order for us to feel a little bit more comfortable that this was a true reversal. The possibility certainly exists, which is why we have those kind of color transitions there. But it's also true, just like pretty much anything in life, that as soon as there's a possible transition, you're going to have a higher likelihood of head fakes. It's only after the transition has proven itself with a little staying power that you feel more convinced that it is something more substantial. So right now, I would still tread a little bit more cautiously, personally. Of course, it's fine if those of you that are listening think differently. That's the nature of the markets. Remember, buyers need sellers and sellers need buyers. But generally speaking, when looking at these charts as we have over the years, we'd like to see price behavior above the 30-day moving average and hopefully stay there for a bit of time to make us feel more comfortable that this is a legitimate bullish move and not just a quick little flash in the pan. So anyway, it's worth noting that we did switch to a weekly bullish posture, but because we are still below the falling 30-day moving average on all four of these charts, I would say that we're still in a little bit more of a dangerous period. Yes, it's nice we had 3 or 4 days in a row to the upside. Don't get me wrong, we'll take what we can get, but we still got a lot of work to do. This is still a market that is far from robust or healthy. By the way, you'll notice that the colors of the moving averages themselves are red across the board to signify that we do have price below falling moving averages, because some of you might be looking at the NASDAQ one down here and saying, well, wait a second, are you sure that's below its falling moving average? It is, but by the smallest of margins. I mean, it is just barely below there. And at one point during the trading day, we were above the 30-day moving average, but we didn't close above it. So had you been looking at this chart earlier in the session, you might have seen that moving average color change to yellow for a brief part of today's trading day. But at the close, which is what matters when it gets kind of locked and set in stone for historical purposes, we didn't quite close above that falling 30-day moving average, even on the NASDAQ, even though it's awfully close. So if we go up just a little bit tomorrow on the NASDAQ, you'll likely see that color change when David's doing the video with you tomorrow night. So we'll wait and see on that. But for right now, all four of our charts officially do remain below their falling 30-day moving averages. The Dow, the the S&P 500. So we talked about both of those changing to their weekly bullish postures today. The NASDAQ had already done that. The NASDAQ switched to its weekly bullish posture back here on what I always joke as is National Truck Drivers Day. 10-4, over and out, right? CB language there. Anyway, October 4th is 10-4. And that was the day that the NASDAQ did switch from this dark pink background color to this light green. So we're actually 1, 2, 3, 4, 5 days in on bullish posture on the NASDAQ. So that would be one way for us to identify that the NASDAQ appears to be the leader of this market at this moment. I don't know if it'll stay that way. A lot of it is probably dependent upon interest rates. But for right now, we do see that the NASDAQ is likely our leader. It took the bullish position first. The other thing that you can use to help you with that is how close are you to the moving average? Well, here we're basically touching it. With these other three charts, we kind of have these air pockets between where the current closing price is and where the moving average is. And then the other thing that you can do to kind of gauge that is look at the label, the green label in each of the four charts. And with NASDAQ, you can see the intermediate green label says it's at 35 and rising, whereas with the S&P 500, it's at 27. With the Dow Jones, it's at 24. And with the Russell 2000, it's actually still in the low reversal zone below 20 at 17. So from that perspective, the number that is the reading of the intermediate line on the NASDAQ is basically 2 times as big as the number for the Russell 2000, just to put that into perspective. So anyway, the NASDAQ appears to still be the leader of this market, and I would say that the Russell 2000 is probably still the laggard, although it's done a really nice job playing catch up. One thing that the Russell 2000 can say that the others cannot is this is actually the 5th day in a row of gains for the Russell 2000. Now, to be fair, that first day was basically next to nothing, but still it counts. This was an up day, this was an up day, and then these last 3 have been a little bit more aggressive. So the other 3 indices here cannot make that claim because it would have been, I guess, last Thursday that those other indices closed a little bit lower there. So anyway, Russell 2000 is working on it, and remember, we've been waiting for them to work on it. If anything, we should collectively say it's about time because, of course, we've been witnessing these oversold cluster signals on the Russell 2000 here for the better part of the last month, and they have rarely worked out the way that you would assume that they would. Right, you got a little bit of a curl higher here, but that is a bit of a whimper compared to how many clusters in a row you got. These other 2 clusters that came here just last week, this is a little bit more of a legitimate move that you would expect after clusters, right? Again, keep in mind that clusters are not meant to have you interpret them as trend changing. What I think of when I see clusters is that there is a better chance than not that whatever condition, whether it's buying or selling that put them into that cluster position, will not continue at the same pace in the immediate future. And so that can work itself off in a number of ways, including going sideways or reverting back to the mean, which is what we kind of hope for if we're kind of playing those clusters. But just because a reversion to the mean is expected to happen in some cases in the short term does not mean that is trend changing. In other words, when we have a bunch of oversold cluster signals like we have had here with the Russell 2000, we should not assume that just because they're showing up that all of a sudden that's going to mark the end of the downward move and that all of a sudden we're going to be going higher in a new bullish trend. Yes, we oftentimes revert back to the mean, but only in the short term, and then we find ourselves still stuck in the predominant trend there, in this case still to the downside. Now, seasonality is also kind of interesting at this moment, as we've been talking about for quite some time now. Remember that September is typically a bad month for the market. August oftentimes is as well. For the Dow especially, August is bad. But for the S&P 500, September is. And we've said that October is a bit hit and miss. It kind of depends. I think October has a bad reputation because a lot of stock market crashes have happened in the month of October. Some of you will remember that I was joking with you here not long ago that if you're looking for a day on your calendar where that might happen, we do have a Friday the 13th coming up this week. So I'm joking about that, of course, but wouldn't that be interesting if we had a crash on Friday the 13th? At any point, or at any rate, I should say, the stock market does have this reputation of having stock market crashes in October, but what is oftentimes forgotten about when you hear about things like that is October is oftentimes where the bottom is set as well, and that is actually what happened last year, right? If we were to pull up, let's say on the S&P 500, let me maximize this here and go to a 1-year, 1-day chart. You can see that the low was set here on actually the 13th. It wasn't a Friday the 13th last year, I don't think, but it was on October 13th last year that the low price was set in the market. And from that moment, we rallied. So it was almost exactly a year ago, right? It'll be a year ago since, this upcoming Friday. So basically the same week last year is when the bottom of the market was hit. And, we've had a pretty nice little rally here in the last 3 days, and actually 4 out of the last 5 days. Could that be the end of it? I don't know. We never did get an oversold cluster signal on the S&P 500. Remember, there were a couple of days along the way I think they were actually both Wednesdays, if I remember correctly, because I remember tweeting about it. But the last couple of Wednesdays, we actually had oversold cluster signals on an intraday basis. But by the close of the market, we had a little bit of a rally where they went away. So when we're looking at this chart right now, you don't see any of those green dots showing up down below it, even though they had occurred on an intraday basis every so often. But if you look exactly a year ago, on October 11th and October 12th over here, you actually did have those physical green dots show up. So not only, having an oversold cluster on an intraday basis, but they actually closed with oversold clusters. And then once you had this massive rally that very next day, that was a massive bullish engulfing candle, and off to the races we were. And that basically, carved out the low. So the point is, from a seasonality perspective, we are in that time of year where bottoms within the market have been known to get carved out. Whether that happens again this year is anybody's guess, but at least we know that there's more fertile ground perhaps on that, because sometimes it's if enough people believe it, then it can become true type of mindset within technical analysis. It's kind of one of those like self-fulfilling prophecy types of things that are out there. If everybody starts believing in it, then all of a sudden everybody starts pulling off their bearish trades and goes bullish again, and then all of a sudden they almost created that effect themselves through their own behavior, which in a lot of ways that's what technical analysis is the study of human psychology and taking the temperature of financial markets through interpretation of price and volume. So anyway, wanted to share that with you there as well. So again, pretty strong day. S&P 500 up 0.52%, Dow Jones up 0.4%, so it was our laggard today. NASDAQ was up 0.58%, and the Russell 2000 was the biggest performer today, up 1.14%. All of them, except for the Russell 2000, now have weekly bullish intermediate postures. The Russell 2000 does remain for this moment with a strongly bearish posture, but with the acceleration of this green line reacting to 5 days in a row to the upside, it wouldn't be entirely surprising if we have another up session in the market tomorrow. We could easily see that the Russell 2000 will join those other three with their weekly bullish postures. All right, let's step away here and take a look at the internet. I always like to get a chance to say thank you to those of you that help support these presentations. Last time I did the video, 106 of you clicked like, and as I always say, as long as we're up and over 100 likes, I'm more than happy to give you a whole hour-long presentation as opposed to more of a traditional, half an hour type of a thing, just to kind of give you a slight reward for your willingness to go out of your way for your 5 seconds to click a button there for me, and many of you are willing to do that. So thank you for that. As I mentioned before, I've now been paid by Twitter, so not that I'm getting paid a whole lot by them as a content creator, but the fact that I'm getting paid something is better than nothing, is the way that I look at it. And so those of you that were wondering in the past, does it actually ever benefit you from a tangible perspective, I can now make the claim that yes, perhaps it does when you guys are willing to click like and repost and comment and all that kind of good stuff there as well. So thank you to those of you that are willing to do that. Let's do some shout outs to some of our best supporters out there who are willing to click like for me in that video. Let's say thank you to Douglas and to John and to Terry and Stephen and Christian and John and Irene and Dividend Wave and Bob and DGI and Options Daily and Leah and Craig and Eugene and Nina and Irene and Jean and Lena and Arthur and T-Fib and Karen and Neil and Elzao and George and Teresa and Fathy and Keola and Ray and Ash, Sunita, Brian, and others. There's too many of you to go through all of you, but I do appreciate each and every one of you nonetheless. Please continue to do that in order to help support both David and I in our efforts here to produce as high quality of content as possible. All right, let's go ahead and now take a look here at our sector selector. A reminder that this gets updated on Friday evenings, and so the information here is a little bit stale, a couple of weeks in, or I'm sorry, a couple of days into the week, like we are here on Tuesday evening. But nonetheless, it can give us a pretty good idea of the flow of money within sectors as time moves along. And you can see that once again, energy stayed number one. Now remember, again, since this was updated on Friday, it would not have had any previous knowledge or input from reaction to what happened in Israel, since that news did not hit until Saturday morning. So it's kind of keeping energy up there after that news, and there would be a surprise to me personally, and of course anything can happen, and I've been surprised plenty, but knowing what I know thus far, it would be surprising if energy would relinquish its number one positioning when the rankings get redone this upcoming Friday, because again, yesterday was a big day for those oil companies. So anyway, this is now 10 weeks in a row for energy being number one and not budging there, right? If we go 3 more weeks with energy being number one, we will be looking at this sector selector in 3 weeks with that brown ball and chain completely going across the top line. And you don't see that all that often. It can happen. In fact, it happened with energy last year when oil companies were doing a lot better than the rest of the market when the stock market was selling off in 2022. But it's pretty rare. It takes a very consistent and persistent move within one area in order to accomplish that. But there's I would say a reasonably strong chance that they could pull it off this time around, knowing what's going on with unfortunate events over there in the Middle East, where you tend to put a floor underneath oil prices to a degree. In the number 2 position, you do have financials. As I mentioned before, the insurance companies are the ones within the financials that have caught my eye from a relative strength perspective. If you look at stocks like Aflac or AIG, they actually have some reasonably strong charts here at the moment, despite a lot of the banks struggling. Information technology stayed at the number 3 position, and so you do have some of those internet security and cloud security plays that actually popped nicely yesterday off of the news over the weekend as well. So that's some of the areas that seem to have the stronger trends within tech at the moment. And then industrials made their way back into the top 4. Now they had dropped out of the top 4 for the 3 previous weeks, but were then able to get back into the top 4 again. And a reminder that the aerospace and defense industry group is part of the industrials. So those stocks like Lockheed Martin and General Dynamics and Northrop and Raytheon and those types of companies are industrials companies. And again, since this was built on Friday night before the Israel news, it's possible that some of those aerospace and defense companies are going to allow industrials to stay somewhat elevated in these rankings. We shall see. At the bottom of the rankings, once again, you do have more of your defensive cohort. You've got your REITs at number 9, you've got your utilities at number 10, and then you got your lowly consumer staples at number 11, much to my chagrin. As somebody who owns a lot of consumer staples in my long-term portfolio, some of them I've held for over 10 years, nonetheless, it has not been a pleasant experience for a lot of them, especially the food and beverage companies have really taken a shellacking here recently, of course, with a lot of this news about Ozempic and Mounjaro and the weight loss drugs and what that might mean for future sales of many of those products that those companies sell. But today, again, a little bit of a snapback day there with kind of Pepsi urging the market along after their earnings report revealed that they haven't seen any legitimate damage yet. Doesn't mean that can't happen in the future, but yet with those weight loss drugs. So right now, they're still kind of stuck in the mud down at the bottom. Remember, those are the areas of the market that are also interest rate sensitive, right? Those are the bond-like proxies that are out there. So until we get a real big move lower in interest rates, you'd have to assume that those areas will continue to struggle on a relative basis. All right, let's go ahead and now pop back on over here to the platform, and let's do some 12 grid analysis. And we'll get started here with chart 5A. This is our asset class 12 grid. Reminder that the background colors of these charts will tell you what the current intermediate posture is for each of these 12 securities we see before us. Let's go ahead and get started in the lower two corners as we are wont to do. And let's start off our conversation with interest rates, since that seemed to be one of the bigger stories of the day. Interest rates, as you can see, took quite a big tumble here today. Now, despite that, because they were in such a elevated level that, you know, like the picture of the kid, I think it was a Banksy piece of art that I had seen from in the past, but I was kind of messing around on Twitter today, showing the Market Scholars logo instead of the balloon there with that little kid that's trying to grab that balloon. Anyway, that's kind of what it's felt like with interest rates lately. It's felt like a balloon filled with helium that you can't quite grasp because it is just up, up, and away. It has been quite damaging to the market as that has occurred. And today, with a move lower of about 14 basis points here on the 10-year Treasury yield, that is one of the bigger moves that we have seen lower on this chart in the last 3 months. Yet despite that, despite the above average size drop in interest rates today, we still have this strongly bullish posture on interest rates at the moment. Remember, that's not good. It sounds good when you say bullish, but remember, that's the thorn in the market side right now. We would want the interest rates actually to be bearish if at all possible. So despite a really big move lower today, because of the highly elevated move that interest rates have had, it retains its strongly bullish posture. I don't know how far away it is. We could probably right-click here. Sorry, let me do this. Right-click, maximize. And you can see that we still have a little bit of flexibility here with this, right? I was wondering if this green line might be really close to 80 at the moment, in which case I might say something like tomorrow we could very well see this go back to a weekly bearish posture. But judging by what I see right now, where we still have a little bit of a gap between this green line and this black line right here, chances are pretty high that even if interest rates go down again tomorrow, we will still retain our strongly bullish posture. And that is not normal. Again, the only reason that's happening is because this was just such a runaway type of a move here, where it basically pushed this green line into really elevated territory. So that way, whenever we do get a sell-off, you got a lot further down to go before it switches postures, unlike other charts that are out there. So it's just a function of the up, up, and away nature of interest rates here over the past month especially. So where we ended today on the 10-year was down to 4.65%. Remember, we were up as high as 4.88% here just a few days ago. So that's been a fairly sizable drop in interest rates in a very short amount of time, but obviously still very elevated from where we were just even 3 months ago, and we're still very close to like 17-year highs. So we'll see where it takes us, but at least for one day, a little bit of a relief rally in some of the bonds and some of the interest rate sensitive areas that were out there. Actually, the bonds, I take that back. Bonds were down a touch today, but I think that's probably a function of the bond market already being open yesterday. Not the bond market itself. I got to be careful with how I say this. The bond ETFs were traded yesterday, even though the bond market itself was not open. So it's a little bit of a strange scenario with yesterday being, I guess it would have been Columbus Day. So, you know, the banks here in the United States were closed and the bond market was closed as well. Also, I happen to notice, not that this really matters to most of you, but just caught my eye because I've been doing these posts on Twitter lately called Mailbox Money, showing you all those companies that pay dividends each day off of the 700 stocks that are on the CCC spreadsheet. Anyway, it was a little odd to me when I saw that yesterday, not a single stock within that group, at least, of 700 companies paid a dividend. And I was like, that's weird. That has not happened on any other trading day as long as I've been doing that, which is for the last basically 2 or 3 months. So it definitely caught my eye, and I think that's the reason. There's probably a prevention of dividends being paid in the United States on a day when the banks are closed for a public holidays. But the stock market was open yesterday, so the stock market already had an opportunity to react to the news in Israel, and therefore, since the ETF world will act more like stocks and it's traded on a tick by tick basis, you'll notice that these bonds were already up yesterday. So like TLT had a nice day up yesterday, BNDX had a nice day up yesterday, and high yield bonds also had a nice day up yesterday. So it was a strange set of circumstances that saw interest rates fall today and bonds actually down very, very small amounts, right? They're basically break even today with just a slight downside action. But the reason behind that is because ETFs representing the bond markets were already reacting to what was expected to be falling interest rates yesterday, even though the bond market itself was not open. So sorry to confuse any of you there. It is a little confusing, especially if you're newer, but I think that's probably the reason why things shook out the way that they did here at this exact moment. Now, of the bond categories that we have here, two of them do remain with strongly bearish postures, and that's long-term U.S. Treasuries and foreign bonds. But you will notice that we've had enough of a pop higher in high-yield bonds, aka junk bonds, that we now have a weekly bullish posture on HYG after putting in a couple of these oversold cluster signals here about a week or so ago. So, there's been a little bit of a relief rally there in even some of the bond categories. In terms of the dollar now, you can see that the dollar was down a touch today. This is actually, for UUP at least, the fifth day in a row to the downside. That has not happened, I would say, probably in the entirety of this 3-month chart. It looks like back here exactly 3 months ago, we had 4 days in a row with this other one, basically being a flat day where that candle is gray over there. So that was about the closest that we've had. And that was a pretty big splash down there. It was a more aggressive move lower than what we've seen even in these 5 days here. But, point is, there's actually been a little bit of a give back there. And that's part of the reason why the background color of UUP is now light pink, telling us that we have a weekly bearish posture. But I would say the same thing there that I mentioned to you about, SPY. In other words, when we have price with SPY below its falling moving average and the background color turns green, I'd be a little bit cautious around getting too aggressively bullish. And the same thing can be said in kind of reverse order for the US dollars chart, where you've had enough of a sell-off in the last week where the background color changed to light pink, telling us that we've got a weekly bearish posture, but we're still above a rising 30-day moving average by a long shot. And so until we start breaching those levels, I wouldn't get too aggressively bearish on the dollar here either. And I hope I'm wrong about that, by the way. As I've told you many, many times in the past, I would much prefer a weak dollar environment. But I'm just trying to be a realist with how I look at this here. And we are still obviously in an uptrend in the US dollar, despite 5 days in a row to the downside. You can see that, both gold and oil were down today, but it's the same conversation there as what I mentioned with bonds. Remember, gold and oil both already had the opportunity to respond to the Israel news yesterday, and both of them went up tremendously. So today was just a little bit of a stalling out after a really big move out of GLD and USO yesterday. Both of them do remain with strongly bearish postures. Of the two, oil does look stronger than gold, but things can change in that regard, so we'll keep our eye on it. If we do see something that is worth your attention, we'll do our best to point that out in these videos. You'll notice here that Bitcoin was pretty flat today, not a big move there, but the point is it stayed above its rising 30-day moving average for the better part of the last couple of weeks now. While most other areas of the market have been more volatile, Bitcoin has actually been a little bit more stable, go figure, especially with all the Sam Bankman-Fried courtroom drama that's going on right now. So Bitcoin does continue to retain its strongly bullish posture and is still above its rising 30-day moving average, even though we really haven't moved much in the last couple of days. And that by itself is maybe worth at least mentioning. Some people might have thought that with the news of Israel being attacked by Hamas, that Bitcoin would maybe benefit from that, right? With the movement of money sometimes restricted when certain parts of the globe go into war. That has been some of the reactions in the past, but this time around that really was not the case for Bitcoin. It kind of just had a meh type of a move the last couple of days after the weekend's geopolitical news. On the top rung here, you will see that not only did the U.S. stock market go back to a weekly bullish posture from a market forecast perspective, but so did foreign stocks from a developed perspective and foreign stocks from an emerging perspective. But I'll say the same thing that I mentioned about the U.S. markets. They're both still below their falling 30-day moving averages. We don't yet know whether this is legitimately trend changing that we should get really excited about, but I would say be cautious around that mindset until proven otherwise, because these could very well just be reversion to the mean moves off of their extremely oversold conditions, and it might not be anything more than that. You could very well see the sellers start stepping in tomorrow, right? Especially in this kind of more geopolitically tension type of headline news market that we're in right now. We just don't know when the next bomb will go off and where it will go off and what kind of damage will be done, right? We're all watching Iran's response to all this geopolitical news, and who knows if they want to get involved in a much more aggressive way, and if so, you'd have to believe that stocks probably would not like that type of behavior. So you just never know. We got to kind of judge this thing on a tick-by-tick basis here at the moment, but at least we have some promise for once, and in the last month, we'll take what we can get, because for the most part, we've seen a straight down stock market. So the fact that we've had these global markets rallying over the last week is at least one sign of promise. Preferred stocks were also up here today. They were up 0.41%. And so, not a great performance there, but still giving us that same type of impression after 3 days in a row of oversold cluster signals. We're getting a little bit of a hope for a push here, but we do retain that strongly bearish posture on preferred stocks. By the way, I didn't mention this specifically here a moment ago, but just to put a ribbon on it, EFA, which tracks foreign developed markets, was up 1.37% today, and then emerging markets were up 1.43% today. Both of them easily outperforming the S&P 500 on a day when the dollar was weak once again. Remember, that's the typical behavior that you would expect there. So with the dollar down 5 days in a row, that's going to give you an extra boost out of some of those foreign areas in all likelihood. All right, let's go ahead and now take a look here at our Sector 12 grid. And as we pull this up here, it's a little bit of a brighter picture than it was a week ago when I was with you, when we had most of these charts, if not all of them, pink or red. Today, we have just two that are that way, and so things have improved from a price perspective within the markets here, and that's reflecting that. The two that remain in the red are materials, which were actually up over 1% here today, 1.06% to be exact, and then staples also remain with that dark pink or red background color, and they were also up over 1% here today. So both of them had nice rallies today, but it wasn't enough to offset the extreme weakness that both of them have had in the last, let's call it, month or so in particular. So those are the two that remain with bearish postures here at the moment. The other charts have all gone to at least light green background color, with communications really standing out with the dark green background color. And now that I kind of think back and it jogs my memory a little bit, I think communications was the one sector that had the light green background color a week ago, and all the rest of them were pink. And I would not have necessarily guessed that we would have moved from light green to dark green as quickly as we did on communications, but that's why they play the game, as they say. And so we've had 3 big days in a row to the upside for communications. Now keep in mind, this is the market cap weighted version of communications, so this is where you're going to have a much bigger impact from Alphabet and Meta, and perhaps a little Disney in there as well, right? Yesterday got the news that we had some rattling of the cages from activist investors over at Disney once again. So who knows when that stock will get its mojo back, but maybe at least stopping the selling for the moment. So communications appears to be our leader from a market cap weighted perspective, as it's the only one that has not only a strongly bullish posture, but it's the only one that is trading above its rising 30-day moving average. Notice that moving average color is green. There's not another single chart on this 12 grid here that has that green color of its moving average. Technology, by the way, is very close. It was green yesterday briefly, but went back to yellow here today. So it's kind of flirting back and forth with that color. Whereas communications, you can see where we ended today, right up here, is well above where this moving average itself is. It's still at its own kind of mini resistance area from a horizontal perspective, but of all of these charts, it is the one that has the most clearance above its 30-day moving average here at the moment. So another way to identify that it's our leader here, you can see its intermediate reading is at 59, which is way higher than all the rest of the labels you see on the board in front of you, with technology coming in at second place there at 40. So again, a reminder that what we were looking at previously on the sector selector is on an equal weighted basis. This approach here with this 12 grid is a little different. This is on a market cap weighted approach, so this kind of emphasizes the larger companies and their impacts on the overall market. So from that perspective, you are getting your big players like Meta and Alphabet pulling their weight within communications, and you're getting, Nvidia and Apple and Microsoft doing a reasonable job within technology. Whereas with the rest of the sectors, it's kind of a little bit more hit and miss, with miss probably coming up a little bit more often than hit. But nonetheless, we are getting snapbacks across the board. Today's top performing sector was actually discretionary. Again, from a market cap weighted perspective, that makes sense. Remember when we were looking at the heat map earlier, we specifically pointed out the big move out of Tesla today from a Magnificent Seven perspective, and also Amazon had a good day. Those are the two most important stocks within XLY, so that is probably why they just, by the smallest of margins, did end up being the biggest movers to the upside here today. The laggard here today looks like it was energy. Remember when we looked at the heat map earlier, there were a number of the larger energy players that were actually down today. Maybe some of the others were able to offset that, but nonetheless, there was not a big move out of the oil and gas stocks today. Yesterday, yes, we had a huge move. You can see that big gap up right there from this candle to this candle. This was Friday, this was Monday. So we already had the big move yesterday. Today, we just had a little bit of a tacking on of 0.12%. So it was our smallest mover to the upside here today. All right, let's go ahead and now get into our trade application example. And as I mentioned earlier, for those of you that caught it, the stock that we will be talking about is Oracle. Oracle was one of the few stocks that really kind of disappointed here today. It was down 0.5% on a day when the market was up 0.5%. And in doing so, you can see that the background color of chart 3A changed from light blue to light pink. Remember, the color schemes are a little bit different on this one because this is the one that we use in my factor-based swing trading class, which of course I'll be teaching tomorrow morning at 11 a.m. Eastern time for those of you that are premium members. But in that class, we're swing traders, so we use this blue line, which is a more sensitive line than the green line. The green line is what we use for trend trading purposes, where we're being in stocks for an intermediate period. That's where you would think months. Swing traders don't think in months, they think in weeks. And so we want to use something that's a little bit more sensitive to help direct our purchases and our short sales, right? We do both in that class. We both buy stocks and sell short companies. And so in this case, this would be more of an example of a stock that we're selling short, at least for this video's perspective here with the market outlook, which is a different portfolio than the class account that we do for tomorrow morning. Nonetheless, the concept is the same. And so after a fairly reasonable rally to the upside after these oversold cluster signals here on Oracle, today was a day of disappointment, and giving some of that back. And kind of in an odd way, considering that today was a robust day for most of the stock market. But today, Oracle was not it, as the kids would say, and we reverted back to that weekly bearish posture there. In addition to that, you can see that we did not get a chance to get up here to the moving average. We had such a massive gap lower on this earnings announcement back here in September, and we have not yet been able to get back above that moving average since then. And so what I'm going to try to do with this particular trade, and the trade of course is already done. Remember, the benefit that our premium members have is access to our private Telegram channel, so that way they're notified when the stock market is open, what the trades are that we did, and at what prices, and what our target prices are, and our stop losses and all that kind of stuff is detailed there in the Telegram private channel. But for the rest of the people that just watch this free video, then they learn about the trades later on at night after the stock market is closed, and then they have to put their trade in the next day if they still want to follow along with it. So I wanted to do a bearish trade here because it had been a while since I've been able to do that. I'm not one that likes to do bearish trades into a cascading sell-off. I'm one that wants to wait patiently for a reversion to the mean type of a move and then reapply a bearish trade where pricing is a little bit more accommodative. It doesn't mean that it's going to be a good trade or anything like that. It's just that that is my personality more than not. And so with the market selling off so aggressively in recent weeks, I had a little bit more hesitation personally putting on a bunch of bearish trades after the stock market had already sold off. So now that the stock market has rallied in the last week, it's giving me a little bit more better pricing to put on bearish trades if I want. And I do like to kind of balance things out within the market outlook trades where we have some bullish ones and some bearish ones going at all times. So figured I'd try to take advantage of this situation here today, now that we can clearly see that that blue line fell out of the upper reversal zone on Oracle's chart here for the near term line itself. And so you can also see that Oracle has underperformed the S&P 500 over the last 3 months of this chart. It's actually down about 4.5% over that time period. It's also done quite poorly over the last 1 month time period. It's done pretty well in some of these other time periods. So this is more of an intermediate, weeks to months type of a mindset that we're looking at here. But I'm just wondering if this was about as good as it gets for Oracle with the last 4 days in a row to the upside and today to the downside on a day when the market was up. Maybe that's a little bit of a poker tell from the market that this one may not be in favor here in the immediate future. So what I did is I put our stop loss a little bit above these price highs of these candles back here on the 14th and 15th of September, and then our price target will be down here where this other thin green line is, which basically means that we would like to get back to the lows of this candle on October 4th, and we would not require a break down and through the prior low at 103. We'd be out before that, but we need to kind of get back down into that general vicinity. So if the market does turn tail and reverses lower here in the immediate future, at least we have a bearish trade in the hopper here, in addition to all the bullish ones that we're benefiting from with the 1 week rally that we're in the midst of right now. Okay, so that's what I had for you. Again, no market outlook video on Thursday as I'm taking the day off. But David will be with you here, as far as I know, tomorrow, and then also with his Friday video. So stay tuned to whatever he has in store there for you. But as long as we're up and over 100 likes by the time I'm scheduled to do this video again next Tuesday, I'll plan on doing another full-length, hour-long presentation there for you. On the other hand, if you think that these videos are getting a little bit long in the tooth and an hour is too long for you, then don't click like. And if we're under 100 likes, then I'll just keep it short and sweet next Tuesday and just keep it at a 15-minute video instead. So I'll let you guys decide collectively. Whatever you do decide, I appreciate you checking out tonight's video, and I'll wish you all the best of success with your trades and your investments. Goodbye for now.